What if you never had to invest another dime and your retirement was completely taken care of? Sounds amazing, right? This is a concept known as Coast-Fi. We're going to talk exactly how much you need to reach Coast-Fi by decade at age 30, 40, and 50. If you've ever wondered how much do I need to just coast to retirement, this episode is for you. Why, hello, my yellow groupers. I'm Carly, a finance grad and the creator of Best Money Class Ever, where I teach how to pay off debt in 36 months or less, invest to retire a millionaire, and stress less about money. Grab a seat. I'm about to spill the financial tea. Are you ready for it? In this episode, I'll share an overview of what Coast-Fi is, how much you need to invest each decade at 30, 40, and 50 to reach this milestone, and what that looks like of how much you're investing each month, plus 2 tips to get to Coast-Fi faster, especially if you feel completely behind. As a recap, what exactly is Coast-Fi? Coast-Fi stands for Coast FIRE, which is Financial Independence Retire Early. This principle relies on 2 finance concepts known as compound interest and the time value of money. You have enough invested at a certain point in time to simply coast until you reach the standard retirement age. I did a full episode on how this works, why it's so popular, and how you can calculate it. I also share my Coast-Fi numbers revealed. I have enough to never invest a dime and still live off of $120,000 in today's dollars with this concept. Make sure and check that out. Coast-Fi is super popular because you can actually have a lot of flexibility when you're not investing hundreds or thousands of dollars a month. You can take career risks, mini sabbaticals, and have a lot of flexibility with your life right now. You can pause the investments to save up for things like a down payment on a home or stay at home temporarily to raise a child. Now, to look at Coast-Fi at each decade, we're going to start off with the assumptions. Of course, with investing, nobody really knows exactly what the stock market's going to do and the economy and inflation and all the things. To lay the groundwork, we're going to have simple assumptions across each decade. The assumptions we're going to look at are your annual expenses, interest earned, inflation, your withdrawal rate whenever you are retired, the full retirement age, and the age that you start investing. Let's dive into why these assumptions are so important and the assumptions that we will be making in this example. First off, why do we need to know your annual expenses? This is in today's dollars what you'd like to live off of in your retirement. The reason why we need to know this is because the basics of planning for financial independence, retire early, or retirement in general is to save 25 times your annual expenses. This circles back to the 4% withdrawal rule, which I'll explain in just a second. For the annual expenses in this example, we are going to assume an annual expenses of $75,000 around the median household income. If you do a tax-free retirement, meaning that you are utilizing mostly Roth accounts, this is going to be tax-free when you are in retirement. If you look at a $75K annual expenses, that's about a lifestyle of about $100K after the taxes. This is a pretty flush, in my opinion, projection and forecast. The interest is what you expect your investments to earn. Obviously, this is not guaranteed at all. The stock market fluctuates with great returns and then losses. Year by year, you never really know exactly what the stock market's going to do. In this example, we are going to assume 10% interest earned. Some people think that that is generous, others think that's right on board. The reason why I'm using 10% is because historically, in the long run, that's the average that the stock market does yield. The next assumption that we're going to look at is inflation. We're also going to be using a 3%, which is about the average inflation historically in the long run. When we look at 10% return and then the 3% inflation, we can understand these in today's dollars. So essentially the effective return we're going to be using is going to be 7%. That takes the 10% minus the 3%. So the 7%, we can look at projections and understand it in inflation adjusted dollars. We are also going to assume a safe withdrawal rate of 4%. Financial independence retire early movement started based off of the 4% rule. Financial advisor was curious, what is the safe amount to withdraw from your nest egg without depleting the funds that would last for at least a 30-year period? And they found that 4% was the safe amount, and that was for a portfolio consisting of 50% stocks and 50% bonds. So it was actually kind of a more conservative portfolio. The person who came out with this study then has recently come back saying, when we look at it, it's closer to a 5% safe withdrawal rate. For illustrative purposes, we're going to keep with the old school financial independent calculations and assume the 25 times rule with a 4% withdrawal rate. For this example, therefore, we are going to look at a 75K annual expenses times 25, which would yield a target nest egg of $1,875,000. For the Coast-Fi by decade, we are actually going to assume that someone does start at age 22. And I know you're probably watching this and being like, hey, we ain't 22 anymore. I just wanted to pick a number, and that's when most people graduate college and start life. So obviously there are assumptions, meaning that the person probably doesn't have debt, they're starting with a decent income. If that's something that you want to see starting investing at later ages, let me know in the comments and I can definitely do a video on that as well. This is also why at the end I'm going to be sharing 2 tips if you feel a little bit late and behind and you are dealing with debt, exactly what to do and how you can boost your Coast-Fi numbers by decade if you're starting later. If you have someone who's recently graduating college and getting started, this is the best time for them to think about these numbers. So make sure and share this with them, hook it up so they can reach Coast-Fi by an earlier decade. In this example, we are also going to assume a standard retirement age of 65. This is what is pretty normal for most retirement planning. If we want to do shorter or longer, we can definitely adjust, but everything would change based on that retirement age. Those are the assumptions. Let's look by each decade how much you need to have invested to reach that Coast-Fi of $1.875 million with a 75K annual spending in retirement. How much do you need to reach Coast-Fi at 30? If you want to have that nest egg of $1.875 million, you would need $175,618 invested at 30 to just coast to retirement. How much would you invest from age 22 to 30? What would that realistically look like? Let's take a look at the numbers. From age 22 to 30, so for 8 years, you would need to invest about $17,200 a year, which comes out to about $14,033 a month. And I know that sounds like, oh my gosh, how do you do that? Well, let's say you do earn a $75,000 income in today's dollars. First, you would max out your Roth IRA. The max you can contribute right now is $7,500. That's 10% of your income. I would recommend taking advantage of, if possible, a 401k plan. In this example, we're going to assume you have a 3% company match. The first 3% that you would contribute, that would be $2,250 that you would get as almost free money. So part of that investment isn't actually from your salary. It's a company benefit, hopefully, ideally. And then in addition to that company match, you would be putting in about 10% or $7,450 into your 401k plan. With a 75K income, essentially you're investing about 20% of your income for your Coast-Fi numbers to work, which is a push. It's a lot. It's kind of crazy. I believe that it is totally doable for most college grads. Say if you're a young engineer, accountant with a in-demand career and a decent income, this is totally, completely doable. How much do you need to have invested to reach Coast-Fi at age 40? The numbers actually do change dramatically. We are going to assume you have the same starting age, so you're going to have longer to invest. You actually would need to invest a less amount per month. What this would look like is you would at age 40 want to have $345,467, and then you could simply let that money coast from age 40 to 65 to reach that 1.87 million nest egg at 65. To reach that milestone, that looks like investing starting at age 22 about $850 a month, which is about $10,200 every year until you reach age 40. What I would recommend is to take advantage of a Roth IRA, investing about $475 every single month, which is $5,700 a year. Then I would also be taking advantage of a 401k plan with a company match. That would be $2,250 that you're putting in, and then they would match that. So you put in $2,250 of your money and they'll put $2,250 of theirs. That would bring you to the $10,200 total that you would need to reach that Coast-Fi. In this example, assuming you do earn in today's dollars of $75,000, you're actually contributing of your money less than 10%. So this path of starting young and just doing a little bit is actually quite effective, and I would highly recommend this for college grads and people who are just starting off, is to start slow. That's also why I created the finance plan, which is the name of the show. The finance plan is your step 1, 2, 3, and 4 with money. I believe that pretty much anyone can get rich on easy mode by just investing a little bit over the long term. And step number 1 with the finance plan is simply to save and invest 10% of your income. That is totally totally attainable for most people. What I recommend is paying yourself first, or essentially saving and investing before you have the chance to spend. The biggest thing is just starting. Even if you're not 22, make sure and just start young and start with a little bit. Your future self will definitely thank you. How much do you need to have at age 50 to reach Coast 5? At 50, you are a lot closer to your standard retirement age of 65. You would just have 15 years left for that money to grow and compound. At age 50, you need a larger amount, but if you're starting at 22, you also have longer to invest. Here's the numbers. At age 50, you need a nest egg of $679,586 invested. This is totally attainable if you're starting right as a college grad. What this would look like is consistently over the course of most of your working life investing $715 a month. Taking advantage of a Roth IRA, you'd be contributing $340 a month, $4,080 a year. We are also going to assume that you are taking advantage of a 401k plan with a 3% match. In this case, you'd be putting in $2,250 and then you'd get that match of $2,250. Again, if you are starting with a $75,000 income, you really don't need to invest that much to build wealth, and then you could still reach Coast 5. It's all about having consistent small patterns, and that's why I created the finance plan. It's just a very simple roadmap that you can totally do and follow. If you want to see your numbers and then also what these numbers look like with the calculations, I actually do have a financial day planner, which is a day planner and financial plan in one. Let me know in the comments below if you want to see the actual calculations. I can do a follow-up additional episode on that. Now, if you're like, okay, Carly, but we ain't 22 anymore, I feel behind, I'm starting later than I wanted to do, there are 2 tips to help you reach your Coast 5 faster. The first tip I do highly recommend is to pay off your debt. The second tip is to optimize your annual spending. The reason why I recommend both of these tips, they go hand in hand, is because a big part of your financial independence number relies on your annual expenses. For example, if you have a student loan, a car loan, some credit card debt, or like a loan on a mattress and random stuff, let's say you have about $1,000 each and every month going towards debt, that's $12,000 a year that you are tied up in the debt payments. There are a couple sides with this. First off, you could actually be investing that money instead if you didn't have the debt payment. And the other side of this is that would be to live off of that lifestyle. The 12,000 times 25 essentially is the extra amount that you would need for your retirement to cover that cost of living. In this basic example, providing for a $75K annual spending, which would be $1.875 million. Let's assume you had $1,000 every month tied up into debt payments. If that debt was gone, you would need $12,000 less of annual spending. What that looks like is you would then be able to lower your target nest egg by $300,000. So instead of needing close to $2 million, you needed closer to $1.5 million. Along with that, I do recommend, even if you already are debt-free, optimizing your annual spending and expenses. If you can get more bang for your buck, master the art of being really good with money and incredibly social without spending a ton, the faster you will reach those Coast 5 numbers. For example, I am 100% debt-free, and last year I had an amazing year. I went on a trip to Australia and New Zealand. My annual expenses were still under $32,000. Being that I can live my best life and not spend that much money means that I am closer to the financial independence. The easiest way to optimize your annual spending is to know where your money is going, and a habit that I recommend is to track your spending. I recommend taking on the mentality of becoming chief financial officer and managing your money like a boss. With that, instead of money ruling you, you take your power back. And just like a CFO would manage a business, you would be running the business of you. I'm a finance grad. I want you to fill in your financial statements. I freaking love financial statements. It's what the Fortune 500 billion dollar companies use to manage their money, and you can use too. There's your balance sheet to track your net worth and see your current value of your retirement nest egg right now. Also looking at your liabilities. If you owe something on a credit card or car loan, it's your snapshot right now where you stand. And then we have your income statement, which is also known as the P&L. It's a profit and loss. You want to have a profitable budget where every month you have money you can spend guilt-free on the things that you love in life, like travel. This is what you think is going to happen, and then to optimize that spending, I do recommend filling in what is known as your cash flow. It shows the actual inflows and outflows in a month. I do recommend, even though it sounds pointless or like, what's this gonna do? I do recommend literally tracking the money that comes in and out on your statement of cash flow. I am really curious and I would love to hear from you. Have you reached Coast-Fi? Are you aiming to reach Coast-Fi by a particular decade? What are your assumptions when calculating Coast-Fi? Are you actually anticipating stopping investing? Are you gonna lower your investments? Let me know your Coast-Fi plan and what you think in the comments below if you're watching on YouTube or listening on Spotify. Thank you so much, my yellow groupers, for listening. Every show has a dope name that they are calling their listeners. I'm calling you my yellow groupers. We have slow starts, we get off track, we get behind, we get knocked down. Life does not go as planned. The cards are stacked against us. The hands we are dealt are not ideal, but we don't ever give up. That is where our grit is born. Our trials, our adversities, that is what makes us stronger. Did you like this episode? If so, make sure to like it and subscribe and share it with your friends who geek out over personal finance. If you are listening on Apple or Spotify, make sure and follow and leave me a review. If you've been meaning to get your finances in order, now is the time, and this is the best place to start. Here, you'll overcome analysis paralysis with the finance plan. This is the roadmap that you've been looking for to pay off debt and invest, even if you have no idea where to start and you're living paycheck to paycheck. Are you tired of figuring this money stuff out on your own? You don't need to spend a lifetime stressed about money. You can turn things around in a month, and I will show you exactly how. Enrollment is currently closed for Best Money Class Ever, my live and virtual 4-week personal finance class. Don't worry, you can start a plan with money to pay off debt and invest right now. I'll show you exactly how. Head on over to bestmoneyclassever.com or the link below. You'll instantly get a free 20-page downloadable guide to start the finance plan. As always, remember, you only live once. Be smart with your money now. I will catch you later. Bye.